Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen. Hello, everyone, and welcome back to the CreditSights No More, Risk Better podcast. This is Winnie Cisar, Global Head of Strategy at CreditSights, and today I have quite the crew to talk about all things autos, repos, delinquencies, and we're putting on a little bit of a Mythbusters edition. This is a complement to a report that this team wrote last week looking under the hood of the auto sector. So joining me today, I have Zach Griffiths. He is our head of U.S. investment grade and macro strategy. We have Peter Simon, our co-head of U.S. financials, Todd Duvick, our head of autos, and then Jory Eisenberg, one of our esteemed special situations analysts who has a great background, especially in Carvana. So thank you all for joining me today to have this fun conversation about the world of autos. And I think to set the stage, let's go back in history. And I would love to hear from the group about your very first ride. So Zach, what was the first car that you ever had?
My first car was a 1996 Chevy Corsica, dark green, also known as the Green Dragon. It was a great ride. Unfortunately, when I went to college, I was not able to take it, so I let my sister drive it, and it went to its demise under her stewardship, so that was a little heartbreaking, but 96 Chevy Corsica for me.
Have you gotten over that with your sister? Are you guys okay now?
We're okay, but clearly I'm not over it if I brought it up here today.
Amazing. All right, Peter Simon, what was your first ride?
So you're asking someone who has lived in Manhattan all of his life. So I still have not had that first car ownership experience.
Wow.
I do have a license, however.
Okay, well that's good. That's good. What's been your favorite car that you've ever driven?
I think so my parents have an Audi A6, so that's
fun.
That's an enjoyable one.
Yeah, that's very fun. Well, good luck to you in your future car buying endeavors.
Thank
or
you.
You know what? Never do it because I hate driving, so I wish that I could be like you. All right, Todd Duvick, what was your first ride?
So I bought a 1962 Volkswagen Beetle from my brother-in-law. Still haven't forgiven him for that. It was a rust bucket, had a battery on a piece of plywood underneath the back seat. And in the winter, since it didn't have a radiator, I had to scrape the inside of the windshield.
I think I've seen you driving that around Charlotte. You still have it?
I wish I still had it.
That would be classic for sure. All right, Jory, what was your first car?
Well, going back about 1,000,000 years ago, as a teenager, I ended up owning some type of very aged Mazda 323, 363. I'm not sure what the models are anymore. It's a manual transmission, probably had 150, 200,000 miles on it. But, as a 16-year-old kid, it was a great car to get around until the transmission literally fell out of the car. Like, I don't know that, but like the gear shift, like there was like an empty hole. You could pick it up off the ground. Then mirroring Zach's comment, I did let my older sister borrow the car one day, and then that was the end of the car.
All right, so sisters are not great for cars. All right, my first car was, I believe, either a 96 or 97 Ford Escort. two-wheel drive, which was fantastic in the Chicago snow, lots of fishtailing to high school. And my car ownership was contingent on driving my middle school brother around. So I decided to leverage that into teaching him how to drive when he was about 12 years old. We would cruise through the western suburbs of Illinois, of Chicago, with me and my 12-year-old brother. And that was a great time. Lots of good bonding. All right. So moving on. Zach, do you want to kick it off?
I'll kick off the questions. I guess Winnie is the only one that had a positive sibling experience with the vehicles, if we can call it that. Maybe slightly illegal, but that's all right. Anyways, all right. I really enjoyed learning about everyone's first rides, but to bring things into focus and kind of hit on what we were trying to one of the big topics we were trying to understand and contextualize in the piece is what's going on with the macro and consumer backdrop. Is the lens of what's going on in the autos market a good lens to understand the consumer broadly and perhaps where we're going? So Peter, I want to start with you, kind of big picture as our banks analyst. How healthy is the consumer from your perspective heading into 2026? And who do you see as stressed and who isn't in this economy today?
Yeah, thanks, Zach. So from the bank's perspective, I think it's actually surprising to a lot of clients that we speak to, but consumer credit is still an improving story. I know that that's kind of divergent from what you see in the headlines, but what's happening there is that consumer credit actually already deteriorated in 2023 and 24 off the back of originations that occurred coming out of COVID. There's sort of a surge of consumer borrowing, that occurred around that time. A little bit of looser underwriting from the financial sector, so there was deterioration throughout 2023, throughout most of 24. That has since stabilized. So I'm mainly looking at this from the unsecured credit card lens. But year over year, delinquencies are now down across the board. So that's moving in a positive direction. Net charge-offs, which tend to lag delinquencies, also down year over year. And you see that in in the auto portfolios as well, which we can touch on further. But I think what's underlying that, one is underwriting has tightened in the past couple of years, and there's also the banks that I cover, the banks and the lenders that I cover, don't focus on the lowest end of the segment, lowest end of the customer, of the consumer segment. So, there is, and this has been the case. This is not news. This has been the case for a couple of years. I think there is, the stress at the lower income tiers of the consumer spectrum. It happens that the banks, don't really play in that area. And actually balance sheet trends from the data that we've been looking at, the consumer balance sheet looks quite strong or quite resilient at the middle and higher income tiers. There's certainly no sign of broad-based stress. Certainly pockets of weakness at subprime, but looking through the lens of the banks, it's still an improving story. That doesn't mean at some point that improvement may stop, and may reverse depending on macro circumstances. But that's the picture right now.
So I guess it's really a story. I feel like there's a lot of bifurcation in the economy now, and it kind of fits in terms of whether you're looking at it through the lens of a bank or a subprime lender. And I know we'll get into some of those trends in a little bit, but I wanted to follow up in terms of automobile affordability. Obviously, price levels across a variety of goods have come up substantially, and while they're not rising as quickly, the levels really haven't come down. So how does affordability fit in with kind of what you're seeing in terms of the consumer impact?
Yeah, I mean, in terms of the affordability of with auto loans specifically, that's part of the dynamic that we need to be aware of here, is that the price of used cars rose, at the same time as the rise in interest rates. So, from the the data that we've looked at, the cost of auto loans as a percentage of monthly income, we had a chart of that in our report. Went from 10% pre-COVID up to 11%, and has now settled out somewhere in between. So specifically from the standpoint of auto, I don't really think that in May at the lowest ends of the income spectrum, I don't think that really, we haven't seen signs that really moves the needle. And then in terms of just overall affordability, as of now, as long as employment in consumer credit is always the kind of the limiting factor here. So as long as employment hangs in there, it looks like the consumer is resilient right now. Balance sheets look strong again outside of that lowest tier. So it has, and part of that is that there hasn't just been inflation and higher costs, but incomes have risen as well, generally speaking. So it looks manageable for now, but obviously we would be watchful for any turn in the employment picture.
That's certainly something we're watching closely on the strategy team, maybe a little bit more concerned than the consensus expectations for next year. So the last thing I want to start with you on, Peter, is repossession rates, and I feel like that's been a huge focus really in the financial press. How does that fit into the whole narrative, and how does it fit into your expectations for auto loan performance?
Yeah, so I mean, certainly, there's data that I think a lot of people are becoming aware of, that repossession rates have spiked. That was the case in 2024 and has continued through this year. I think there's a few things to be aware of, and I think basically, I think this is more a reflection of cyclical dynamics than anything going on right this moment. So with consumer credit, what you're seeing in data right now is not necessarily a reflection of only trends that are happening right now, but it's a reflection of lending that was done a few years ago. So with auto lending, the loss cycle, depending on who the borrower is or what type of borrower, tends to be at least 2 to 4 years for a loan to go from origination to loss. So I think what we're seeing in the data, and we know that 2022 there was a surge of origination, as I mentioned. The affordability of the loans was getting more stressful, certainly to consumers at the lower end. A number of other kind of idiosyncratic post-COVID factors played into that as well. And just more aggressive origination, competition for loans at the time. So we've seen across a number of lenders that really 2022 seems to be the bad guy as far as vintages. So loans that were originated in 2022 have had higher loss content than loans that were originated either before or after. So I think, certainly, there is that, the element of truth here is that there is still stress for subprime consumers, but I think a lot of what we're seeing in terms of the metrics that are being reported are a reflection, are a little bit backward looking in terms of what the origination dynamics were at the time. And then we've also had a number of comments from lenders that I cover, such as Ally, Capital One, that for more recent originations, they're not seeing very divergent trends between prime and subprime. So I think, that'll take time to really show up in the data. But I think that's an interesting signal that, maybe what we're seeing right now is not a severe deterioration in subprime, and maybe is a bit more backward looking.
Yeah, I mean, I think it makes a ton of sense to consider the repo rate as a bit more backward looking, but that's certainly not how it's been reported in the financial press. So I think that that's a really important thing to clarify. So, Todd, I'd love to hear a little bit more about some auto specifics because we do know that affordability has become a bit more challenging in the world of new and used cars. Do you think that there's any relief in sight in terms of that affordability pinch for cars in general?
Uh, Probably not. Um, to lead with the negative, but there is a caveat, and I'll get to the caveat in just a minute. But if you take a look at pre-pandemic, the decade before the pandemic, the average transaction prices of vehicles increased about 3.5% per year. So that's pretty healthy inflation. It's above the overall inflation rate, and that has to do with the mix of vehicles. They continue to get big, they continue to add features. So about 3.5%. But then if you take a look at during the pandemic, because of the shortage of vehicles, we saw prices rise for new vehicles 30% over a very short period of time. And there has been some give back in prices in 2023 and 2024, but pretty small. And if you take a look at where prices are today, they're still at that 30% higher than 2019 levels. So yes, we've got affordability concerns. The reason we don't think they're going to get uh, better anytime soon is you've got tariffs. That's a huge cost for automakers. Now, so far, the automakers have been hesitant to pass on uh, the tariff costs in the form of higher prices, largely because of the optics of it. But they are expected to increase prices with the 2026 model year. We think that prices, instead of going up 3.5%, could go up more like 4 to 6% next year, which isn't crazy compared to the historical levels, but it is a headwind. The other things that automakers are doing to pass on the tariff costs is destination fees, which are over $1,000 per vehicle. Edmunds says that they're increasing the destination fees by 8.5% this year on average, and those can continue to go up. That's something that consumers have to pay. And then you've got shrinkflation, basically the same price for a vehicle, but stripping out some of the details, some of the features of the vehicle. So that's a form of inflation that the potato chip industry has been using for years now in cars. So that's the bad news. The good news, if there is some good news, is uh, the data that we're using shows that certain car loans, not only by captives, but also by some of the lenders, are down somewhat year over year. Whether they continue to be down um, going forward, depending on the interest rate trajectory, that can be positive in that it can help to offset the higher prices in terms of the monthly payment. Monthly payments are up about 40%. This is data from Experian. So 40% compared to the pandemic. So that's a huge headwind. So if you get some relief from interest rates, that's going to help the affordability. Interest expense is going to be deductible on car loans, obviously with certain restrictions, but that's going to help some consumers out. And then you've got more availability of lower priced cars in terms of sedans that are coming out from manufacturers like Nissan, Hyundai, and Kia. So that can also help.
All right, so a little bit of a mixed outlook there for new car prices, but
Right.
some positives. I would love to hear about the used car market. I know that we've seen some pretty high profile defaults lately from Tricolor and Primaland, and there might be some impact on used car prices from that. How are you thinking about the used car market? Is it still super tight because of that shortage in production during the pandemic, or is it loosening up a bit?
So it's loosened up a bit, but it is tightening for another reason. So the first thing to know is the used car market is more than 2 times bigger than the new car market in terms of annual sales. Uh, but there are supply and demand effects from one that affects the other. So what you mentioned is during the pandemic, the new car market was very tight because of a semiconductor shortage. That resulted in prices for used vehicles increasing more than 60% at the peak. So double the price impact from new cars. And that's because new car buyers were looking for vehicles that weren't around. And so they turned their attention to the used vehicle market, just really bid up the prices of used vehicles. They've given a lot of that back. And similar to the new vehicle market, used vehicle prices today are up about 30% compared to the pandemic. So about the same increase as we're seeing in the new vehicle market. So the new vehicle supply demand has normalized, but the impact that we're seeing from the new vehicle market today is during the pandemic, there really weren't many leases that were underwritten. Leases are a more affordable option for consumers that really don't make as much money in general for the automakers. And so there wasn't the need to offer leases when they didn't have the supplies. And so now we're at a point where off-lease vehicles usually represent about 10% of the supply in the used vehicle market. We're seeing that this year and the next year go down to about negligible levels. So that's going to be a supportive factor in terms of supply, helping to support the prices. So, we think that, and we've seen prices actually increase this year with so that's a positive supply factor. What we're seeing with the charge-offs, the repossessions, the delinquencies is, at least in our captive supply or captive finance organizations, is we're seeing pretty stable trends there. What I think Tricolor and PrimeLend have done specifically is it's seen a temporary bump in the repossessions related to that, higher auction volumes and some pricing weakness. But we think that's going to be temporary. Kind of longer term, we think that these are one-off events and we'll quickly get back to kind of normal supply demand factors in the used vehicle market that we expect to be supportive because of the fewer off-lease vehicles, but also we think that with some of the tariff costs being passed on in the new vehicle market because of the correlation of the two markets, we think that's going to be slightly supportive for the used vehicle prices in the intermediate term as well.
All right, so maybe a little bit of a temporary pressure on used vehicle prices as we kind of work through Tricolor and PrimeLend, but the more medium to longer term outlook seems like still a bit of a tight supply constraint. So,
Yes.
Jory, I think that it would make a ton of sense to start talking a little bit about Carvana and CarMax, which are, two of the big used car dealers. Now, I know you don't have official coverage on these two companies, but you do follow them to an extent and did some great work in that report that we put together. So we've seen some kind of diverging trends. It seems that CarMax reported kind of weak earnings for its fiscal Q2 26, which was, I think, back at the end of August. While Carvana more recently seems to post, a little bit better quarter overall. How are you thinking about the factors driving that disparity? Is it a company specific thing or what's happening?
Sure. And Todd, laid out good groundwork for just, I guess, the macro theme that's like affecting the used car market. I mean, it's a very fragmented market. I mean, there's a lot of franchise dealerships across the country. But I mean, the two biggest, if you were to point them out, would be CarMax and Carvana, as you say, CarMax being number one, Carvana number two. But together, I think they're only like 2% of the market. Or, I mean, as of a couple of years ago, it probably hasn't changed much since then. But yeah, I think people looked at CarMax, which reports end of August, kind of a quarter early than Carvana, with relatively weak numbers kind of across their core operations, as well as the consolidated results, and saw a potential canary in the coal mine there. I think that was dispelled a little bit, when Carvana came out a month later with their results, with very divergent trends. Posting, unit volume growth, revenue growth, decently strong EBITDA margins, a slight give back on gross margins, but nothing overly concerning there. And I think the reason is something that we had talked about for quite a while. I mean, we don't cover Carvana officially anymore, but had covered it since the beginning, or I guess mid 2022 through the end of 2024, where it had a rise or fall and then rise and then kind of stabilization, rise, fall again. Very volatile name. If anybody's tracked the stock price, it's been a very wild ride. Um, but I mean, essentially, there's some similarities between the Carvana and CarMax business models, but they also diverge to a degree too. Like, for instance, the way they handle auto finance is dramatically different. Carvana has some back-to-back financing facilities that it uses to underwrite car loans, primarily itself initially, but then it rather quickly tries to offload that risk to its various partners, as well as the ABS markets. So the key channels would be prime and non-prime ABS securitizations, as well as direct whole loan sales, with the primary partner being Ally Bank or Ally Financial. And more recently, I think they started using an additional third party that they never disclosed who that is. But you look at the footnote disclosures for the last quarter, and those relationships seem quite strong still. So Carvana's only retained a rather small balance of residual from its loan exposure, and everything else continues to be pushed out to the ABS markets or to Ally and others. And I think just I think it was in October, the company announced it re-upped some of those agreements with Ally to extend out those commitments farther into the future. So it's, I guess, challenging, to connect the theory that lenders are tightening up and kind of getting anxious, while at the same time they're continuing to kind of accept and take on additional risk there. So I think that is a helpful data point. Shifting over to CarMax for a minute, we never officially covered it. Not much debt in that structure, but it's definitely a useful comp to understand the operational profile of Carvana. And the core operations, I mean, they run a fairly similar business for how they sell cars, but for a variety of reasons, Carvana has just been taking share from them for several quarters in a row. I mean, it's as many as 8 quarters in a row, really, where you're seeing differing volume growth trends and differing margin generation. It's effectively offering a product or a brand profile that is more appealing to customers, potentially a slightly lower price point. But on the loan side, CarMax does retain a lot more of that risk. I think just looking at their recent Q, I think they say they probably finance in aggregate maybe 70% of their cars sold to their various car customers, but only like 40% of it is like directly using their own facilities, and they have a bunch of other third parties that come into their platform, either that pay CarMax fees. In some instances, in certain credit profiles, CarMax actually pays them fees. But they give a little bit more granularity, I guess, for the retained risk, which is substantially more involved than Carvana, of what like the health of that loan portfolio looks like. We never done any kind of deep dive into the ABS structures, which generally have public filings as well. But there have been recent issuances of the prime and non-prime facilities of the various companies, Carvana, CarMax, and you definitely do see some data in aggregate that shows some increase in charge-offs and delinquencies. But I think, as Peter mentioned earlier, information from both companies seems to reflect that same data point, that it's really vintage specific. And, some of these car loans are still in existence. I think there was some kind of duration extension that's happened over the last several years too. So, I mean, it's not necessarily, you're talking about 3-year car loans. I mean, some of these are 5, 6, 7 or more year loan facilities, and they're still midway through their amortization profiles. So, I mean, these 2022, 2023 vintages, I think CarMax said really up through like April of 2024, there were some problematic vintages that they were facing that are still working their way through their portfolio. CarMax did say they started tightening their underwriting approach, basically mid 2023 and onward. So they kind of mitigated some risk there. But I mean, basically when customers were facing those sky high prices when they acquired these cars, and then significant depreciation since there. I think Todd mentioned like you were at 60% increase, and now it's kind of deflated down to about 30%. So they're probably finding themselves underwater on a lot of these vehicles, which gives them some incentive to potentially, walk away from some of their these vehicles in that vintage range, and in some cases. But um, I think both companies, Carvana and CarMax, have been relatively optimistic about, I think, from early 2024 onwards, like the new loans being underwritten, that they feel good about that loss profile, and how they're, um, basically charging interest and covering their risk from that perspective. And I think the fact that their lending partners, Ally and others, are still very much interested in continuing to do a business there, I think reflect the general view in the financial community that it's still an asset class they want to be exposed to. They just have a bucket of kind of problematic loans that aren't fully worked out yet through the system.
That's super helpful, Jory. I was listening to a podcast this morning on my drive in to work when I was actually stuck in traffic and about to lose my mind. And they were talking about the potential for 15-year car loans to help with affordability, kind of along the lines of the old 50-year mortgage that's been kind of floated in the headlines. Sounds like a great way to have a lot of debt and not a lot of equity in consumer pockets. So we'll see where that goes, because I think that your point around a lot of loans being underwater, especially with the depreciation that we've seen in used cars versus the peaks, is really important overall.
Yeah, I think, I mean, Todd and I actually cover, Hertz, the rental company, together. And that company in particular is kind of referred to, I believe they call it excess depreciation, I think, Todd, where or extraordinary depreciations. Like, there's the normal depreciation curve that you'd ordinarily expect on an otherwise depreciating asset, but that 60 to 30% gap is something that needs to be kind of closed out before you can get back to normalized conditions. So there's definitely been an extraordinary period of time as that normalization occurs.
Yeah, some of those numbers are staggering. So, Winnie, I want to shift to you and kind of put this in context in the various markets that we cover in corporate credit, and we already talked about ABS a little bit, but can you kind of give us the rundown of auto debt outstanding, the big players in the market involved, and some of the insights that we commented on in our report using our colleagues at DBO1's lens into the subprime market?
Sure thing. Yeah. So as you mentioned, Zach, we have a Fitch Solutions sister company called DVO1 that does really great deep dives into the world of ABS, and they have an excellent monthly subprime report that I looked at. The most recent one out was for September 2025, and they recap both what is happening with auto loan performance across bank balance sheets, which is about a third of auto loans outstanding, and then what is happening within the subprime auto ABS market as well. And I think that the big takeaways that I found from this report was there are some really specific nuances as to some of the weakness that we've seen within the auto loan market. Some of it is regional. I think that we've seen a lot of headlines around, things like Florida real estate. So maybe not surprisingly, the Florida, Georgia, South Carolina regions have also seen some declines in auto loan performance. Same with Texas, Oklahoma, and Louisiana. We've also seen within the subprime auto ABS space that there's a lot of kind of multiple offenders in terms of delinquencies, where it'll be people who kind of go delinquent over and over again. So really showing that bifurcation, or with consumers who are having the most difficult time keeping up with payments, is very much entrenched within the subprime space. And then another one was just, loan to value has become a really significant consideration when we are talking about what's happening in the auto space, especially subprime ABS, because we have now a lot of really high loan to values and frequently underwater. And when you have loans with an 85 to 95% loan to value rate, you're probably going to see a charge off rate that is a little bit higher overall. So that's definitely another thing to kind of consider in the moving pieces of the broader loan market and all of the debt outstanding. And then, when we look at what is actually within the world of corporates, it's a little bit more contained. The auto sector is not nearly as large as it once was, call it in the late 1990s, early 2000s, when it became kind of a problem child among a big downgrade and default wave. So it does seem like from a corporate credit perspective, autos are a little bit less of a significant headwind overall. And I know that Todd has had a more favorable call on the auto sector, even with all of the different moving pieces of tariffs and high prices and supply chain issues and all of these things, with some pretty great calls on some of the key issuers within the sector.
Todd, maybe we'll go to you to just expand on some of that and kind of how you're thinking about auto risk within the corporate credit market. I'd say the sector has certainly exhibited outsized influence on valuations in the early to mid 2000s, and again during Ford's various upgrades and downgrades. Do you think we're setting up for a similar cycle to what we saw back in the early to mid 2000s?
Yeah, that's a great question. And the simple answer is no, I don't think so. Because if you take a look at the sector, it's really been prone to disruption from a couple factors. One is technology, that's going to continue. The other has been competitors. So if you go back 60 years, the big three, which at that time were Ford, GM, and Chrysler, had about 80% share in the US. Then you had the Japanese wave throughout the 70s, competitors coming in. Then in the 90s and early and the aughts, you had the Koreans come in. So I think it's important to keep in mind that what is happening today um, is we've got stability in terms of the competitors in the US market. And I think the other factor is that what happened with the pandemic is you saw a fundamental shift in these companies' go to market strategy. Previously, it had been a volume driven strategy focused on gaining market share. They saw, because of the huge price increases during the pandemic, that if you limit the inventory available to the consumers, who would have thought you've got pricing power? And so, what they have, it seems like they're all singing out of the same hymn book now. They are more focused on a profit driven strategy as opposed to a volume driven strategy. And I think that as long as the competitive set stays relatively constant, I think that signals that we're going to have some stability and good profit pools here in North America. And interestingly, as painful as the tariffs are for all of the players, the two that have benefited the most in terms of gaining market share throughout this are the two homegrown companies of Ford and General Motors. And so I think if you take a look at the tariffs, yes, they're a profit headwind. They're not a rating headwind because the rating agencies recognize that they're an exogenous factor that is going to take the companies a while um, to adjust to. But at the same time, they're looking at the competitive factors. And I think the fact that they're focused on profitability, they're focused on maintaining their market share, and actually Ford and GM can grow their market share, puts them in a better competitive position. And so as we take a look at the risks, we think that the risks are going to be relatively contained as long as the policies in North America are not focused on pain of tariff costs for the automakers, but they're focused on keeping China out. Because China could be a huge disruptive factor in the US market because they lead on technology and they lead on price. And if they were to be allowed into the US market like the Japanese were in the 70s, the Koreans in the 90s, I think you would see some significant pain in terms of market share losses and profit losses for all of the players in the North American market. I think eventually we're going to have to figure out a way to play with China. But I think right now, the Trump administration's focus is really on kind of protecting them, allowing them time to catch up from a technological standpoint and from a cost standpoint. And then figure out at some point, it's going to be beyond the current administration, how we can allow the Chinese into our market in a more disciplined way.
A lot of great stuff there, Todd. A profit-driven strategy. What a concept.
How about that?
Sounds innovation that excites. Peter, I wanted to round back to you and kind of get your views on what we need to see happen, what would need to happen in the broader consumer credit landscape to result in system-wide stress from the auto loan sector. It sounds like from your perspective, at least what you see through the banks looks pretty solid and if anything improving, but what do you think you'd need to see in consumer credit to cause a bigger stir for the economy and the market broadly?
Yeah, so I mean, I think it's an important question because there has, as we mentioned, there's been a lot of headlines around this topic, and I think what people worry about is, what is there a transmission mechanism from, subprime auto stress to the extent that there is some to other parts of the financial markets or to financial companies. We don't. I don't really see it currently. For the banking sector, there is not really subprime auto specifically is not a significant exposure for larger banks and larger regional banks. They largely lend to prime and super prime. Um, so even if things were to get worse in subprime auto, I don't really think it's not something that really impacts the banking sector. Obviously, we've seen it have impacts on specialty, certain smaller specialty lenders. Those are not in any way systemic. Even if you had some loan losses, from the Tricolor situation to other banks, very manageable in size. And I don't think the exposure to that sector is large enough to really, to really move the needle. I think in terms of, I think what would be more concerning, generally speaking, from a consumer credit standpoint, is if we started to see stress, outside of that lowest income tier. If we started to see, started to see more signs of stress at mid, near prime, prime, or unlikely we would see it in super prime, but I think that would really, that circles back to the concept that, ultimately in consumer credit, what matters is employment trends at the end of the day, coupled with origination. But if we saw employment trends really deteriorate for those, for those higher income, mid to higher income buckets, I think that would be more concerning. I don't think it would be all that concerning from an auto lending standpoint because it's a collateralized product, and that there is some limit to what kind of losses you're going to see there. But I think that in a broader macro sense, I think that would be more concerning. But I think the headlines that we see around subprime, I think there is kind of a people think back to, obviously when people hear subprime, they think back to, the 2007, 2008 with subprime real estate. There really is not, in terms of contagion effects or transmission throughout the financial system, that there's no analogy to be made here.
All right. Well, I feel like that might be a good place to wrap this up. If we're going to say that there's no analogy in subprime auto to subprime real estate, that feels like as positive as we are going to get this year. So I maybe appreciate ending on that note. So, this edition of the CreditSights podcast, Mythbusters, is going to wind down. It seems that for right now, autos are not a systemic risk to the US economy and financial system, but definitely a lot to monitor in terms of what is happening underneath the hood of subprime and thinking about some of the aging and seasoning of those 2022, 2023 vintage loans. I want to thank Peter, Zach, Todd, and Jory for joining me today. This was a great conversation, and I appreciate you all mobilizing to put together that report. For anyone who's listening, if you are interested in seeing that report, you can always reach out to your CreditSights salesperson. And thank you so much for listening today. And that will wrap it up.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.